call this meeting to order, Finance Committee for January 15th. Robert, you want to do the roll call?
Yes, sir. Chair Polito,
Here.
Vice Chair Lee, excused. Yogesh Amli, Ms. Walker,
Yes, here.
Ms. Patel, Mayor Whitmer,
Here.
and Vice Mayor DeGoy, we believe, join us shortly.
Public comment. We have some members of the public here. Nothing, Jim? Then we'll move on to the regular agenda. We have a copy of the draft minutes from the meeting in November. Hopefully you had a chance to review them. Did anybody see anything that was missing or incorrect? Were you raising your hand or waving at Rick?
I was waving at Rick.
Okay. Then I would entertain a motion to approve the minutes as written.
So moved.
And second. All in favor? Aye. All right, now we're going to move on to the main part of the meeting, discuss we finally have financial statements for the year that ended last June.
Yes.
And I can do it, but Robert, you
No.
probably want to introduce Catherine.
Yes. Welcome, everyone. Happy New Year. Just wanted to, again, just kind of briefly discuss again, this is the 17-18 audited financial statements. And just a brief highlight, general fund revenues of $17 million to expenditures of $12 million, and our transfers out $614,000. There's an excess revenue over expenditures of $4.3 million. You have the staff report before you. Highlighted some items in there that we will probably not go through in detail, but just wanted to note that the general fund has a positive fund balance of $17.3 million. And as we get into the fund balance, the 15% contingency is at $1.8 million in the report. Under the fund balance for the general fund, it's listed as $1.7 million, so we'll make an adjustment to that. So I just wanted to note that. Again, we have our audit engagement partner, Catherine Yoon, here to kind of discuss the audit, and then we will have any questions. But those were my highlights. We have some PowerPoint that we're going to go through. If we can I'll just pass it.
I'm sorry, Robert, were you saying there's an error in here?
On page, it's just an error as far as just updating the 15% contingency reserve, and I will tell you which page that would be. It is page 22. So the 1.7 million that's committed, that's the 15% contingency, and it is at the calculation of 12 million expenditures. At 15%, the new balance will be 1.8 million.
Did you say page 22?
Yes, of the financial statements.
That's
The
the
one that shows
government
the
funds balance sheet.
Balance sheet?
Yes. On the fund balance, if you look at where it says committed, it says 1,743,000. All of that's just going to be reflective of 1,809,000. That's 15% of our general fund expenditures of 12,065,000. So I mean, the total fund balance doesn't change. It's just we're just allocating that committed 15%.
So, are we allowed to ask questions, Mr. Chairman?
Oh, absolutely.
So in the management discussion and analysis, page 5, okay, the unassigned fund balance 14.9, does that include the money that was allocated for the emergency reserve fund, or is that exclusive?
14.9.
Yes, it's like 2/3 of the way down. Next to last.
That's taking out the committed
Okay.
component.
Okay. And so there are some other numbers that, if we don't go over that, the year's closed and we're happy with the way the year worked.
Mhm.
A lot of the report for me looked good, but I have a couple of questions on a couple of numbers, and I'll just,
Okay.
with the accept way.
Okay.
Thank you.
Very good.
I appreciate all the analysis done.
Thank you, Mayor. So without further ado, I want to introduce Catherine. Everybody knows Catherine. And if we have a presentation from her, we'll answer questions after that.
On the board or just here?
It's in there.
Thank you for having me, and thank you, Barbara, for the introduction. So I would like to briefly go over just the audit results and some financial highlights. Some background information. I'm with Mason Associates. I'm the engagement partner. I've been with the firm for almost 23 years. So we have conducted the fiscal year 2017-18 financial audit. We came out to the town twice for 2 time period last year. We came here in April, and during that phase of the audit, what we call the interim audit, we obtained an understanding of the internal control environment of the town. We interviewed town staff, we verified what they said, we also put some transactions to test. And then we came back in October. During that period, the town management has already prepared the financial statements. So our main focus then was to verify the numbers that you see on this set of financial statements. Our opinion date was December 23rd. However, most of our work was already done in October, but because of the current audit standards, we cannot date our opinion until certain things had to happen. So that's why you see the date being so late. Okay, then page 3 of the PowerPoint. We followed 2 different standards for when we conducted the audit. We follow the auditing standards generally accepted in the United States of America, which is the audit standard that all auditors follow in this country. Based on the council request, we also follow the government auditing standards. Most of the time, we perform audits in accordance to government auditing standards when there is a grant audit. But during the last request for proposal for the auditing services, the council wanted us to follow that standard also. So what that means is that we perform a number of additional steps in addition to the auditing standards generally accepted in the United States. The result of the audit is that the town received a modified opinion, which is the highest level of assurance we can give to a set of financial statements. So most of the time, what it means is that it's a clean opinion. The most exciting thing this year in our world, and probably just
Accounting is
ours,
exciting.
I'm glad that you qualified that.
Exactly. Was that the town implemented a new accounting pronouncement. The government accounting standard board, which is kind of like a cousin of what you're probably more familiar with, the FASB. So this is the GASB. Issued statement 75 a few years ago. What that means is that before this was issued, the town did not book the unfunded portion of the OPEB trust on your financial statement. So OPEB is the other post-employment benefits. So that would be the medical, dental, that kind of stuff for retirees. Last year, if you recall, the town implemented a portion of this kind of like a suite of GASB, the GASB 74, which put the trust fund onto your financial statements. This year, the town reported the liability of that. As a result, there was a net OPEB liability, which is a new item on your financial statements for $4 million. We also revised footnote disclosure 8. So now your OPEB footnotes look very much like your pension footnotes.
They did last year.
Well, they did in most. Well, last year we had to do both. You're right. So this year we basically clean up the remainders of GASB 75, and so it looks very much like the pension footnote this year. Okay. some highlight on the basic financial statement. Some of you may be already very familiar with this, so this is just a very general overview. There are two sets of financial statements in this package. So in the front, you will see statement of net position, statement of activities. Those are what we call the entity-wide level financial statements. Essentially, they are the consolidated statements in the front. You will see items such as long-term assets, long-term liabilities, very much like a set of corporate financial statements. Then behind that, you see the fund financial statements, which is in this accounting basis called the modified accrual. So what the focus of that is just the near-term assets and liabilities. The idea for fund financial statements is to allow decision makers to make a decision for the near term, for the next 12 months. So you will not see long-term assets and long-term liabilities there. Okay? So we're going to go over highlights for both levels of the financial statement. So page 7 of my PowerPoint, I just want to highlight a few numbers. Net pension liability, which, the town has no long-term debt. So the two biggest long-term obligations number are net pension liabilities for $16.1 million, which was a $2.1 million increase. Most of that increase is the result of the change in the accounting discount rate. As you see on the footnote, the accounting discount rate changed from 7.65% to 7.15%. And for net OPEB liability, which is a new item, was $4 million.
So exactly where am I gonna find all these long-term entries that we've made?
So that will be,
Early on.
and on page 18, I don't know, do you have the
Yeah,
number?
page 18 shows the statement of net position, so it'll show for the liabilities, the net pension liability due in more than 1 year, that's the 16.1 million. And then the net OPEB liability due in more than 1 year is the 4 million. So these are listed in there.
I see it.
Yeah.
And so that particular balance sheet is the entity-wide level balance sheet.
Correct. Now, keep in mind that because how long it takes to estimate these pension liability and OPEB liability, these numbers usually 1 year behind your financial statement year and date. So sometimes people, when you think about it, if there's market fluctuations or if the town has made a contribution, it may not show up until the next actuarial study that will be reflected in the next year. Okay? So net position was ended the year with a $57 million, which was a $6.5 million increase. Okay. The next page, so if you want to follow my numbers, so now we're on to page 22 of the financial statement and page 8 of my PowerPoint. So general fund balance ended the year with $17.3 million, which was a $4.3 million increase from last year. So and then you can see that the breakdown below. Now, the town has two different requirements for general fund. As Robert pointed out, the committed fund balance will be changed to about $1.8 million. And then the other requirement was that 20%, 20% of the operating expenditure, the actual operating expenditure has to be in the unassigned fund balance. So,
And that would be 2.4
yeah,
million.
and you are at $14.9 million. Okay?
So that committed number, the $1,809,000, that's the,
The 15%.
all the prescribed reserves, all
Yes,
of
sir.
them.
Yes, sir. That's the 8 is, which was currently the 1.7, it'll become 1.8. That's the 15% required emergency contingency. The other component, the 20% of reserves is in the unassigned. But
Oh.
we back it out.
So it's only the 15, I mean, I can't do the math in my head, so, okay, that makes sense. And the $620,000 assigned?
That includes a portion of the 505,000 facility fund, and then 181,000 is the tennis fund, and then 4,800 is committed, the tree component.
So when you changed, when you changed the committed number from approximately 1.7 million to approximately 1.8 million, did that come out of unassigned?
Yes, sir.
Okay,
Yes,
so
ma'am.
that changed too.
Yes, ma'am. It'll be reflected
Yeah,
in there, and
okay.
we'll update that.
Got it. So the bottom line's the same.
Yes,
Mhm.
ma'am.
So if you want to know the detail of the components of the restricted, assigned, and unassigned, this is on page 58 of the financial statement.
Just go there.
Okay.
So note 6 is for the fund balance. Page 58 just shows the different fund balances across all major funds and the general fund.
So our original budget for last year, we budgeted 15.7 million in revenues. We actually came in at over 17 million. We budgeted 13 million in expenditures, and we actually only spent 12 million.
Mhm.
And we budgeted a final general fund balance of 17.3 million, and we actually, excuse me, of 13,959.
Mhm.
We actually came in at 17,346.
Yes.
So to me, that's the highlights of everything,
Right. That's that
Sure.
4.3 million increase.
despite all the things that I don't understand, with primarily focus on pensions. but-
More revenue spent less, nothing more.
Yeah.
The bottom line. Correct.
Okay. So on page 9 of my PowerPoint, what I'm trying to show there is just to compare what the town's current situation was on June 30th, 2018 versus what the recommended practices. So currently, there's no requirements of how much fund balance an entity should have. There's this organization out there called the Government Finance Officer Association that is a national organization for both the United States and Canada. They published a best practice in 2015 saying that in general, a government entity should have, in the general fund, should retain about 2 to 3 months worth of, to retain enough fund balance to cover 2 to 3 months worth of either revenue or expenditure. So I usually use the expenditure number because of all the contracts that you committed to. The average fiscal year 18 monthly expenditure amounted to about $1 million. And when I compare that to the unrestricted fund balance, which is the committed, assigned, and unassigned fund balance, it was about $17.3 million. So let's say that if starting July 1st, 2018, the town stopped getting any kind of revenue, the fund balance should be able to sustain you for 17.2 months. So that's a very healthy number.
But it's
I mean-
not as good as 2 to 3 months. Oh, I'm sorry. I was
A
thinking
lot
2 to 3
better.
years. No, I was thinking 2 to 3 years. Sorry, my brain
That would
is
be nice,
in the wrong
right?
unit. Wrong unit.
Is that just operating reserve or is it emergency reserve?
So this includes your
Everything.
Emergency reserve, includes the
I
one.
can't, I didn't write the report and I hadn't seen the report, but emergency reserve normally would be a year, I would think. Cover for a year if you have an emergency as opposed to one. I think we have enough for a year in all of our reserves, but, say 2 to 3 months, you know, instead of having 2.3 or $3 million is all the reserves we need. I think that's a little bit low personally. Although, you know, I certainly welcome your advice. If you're recommending that we release some money, then we would, as a council, consider that, but I'm not sure how much we would consider releasing, but
So,
we're always looking for money to be released.
I don't, that's not my recommendation, that is the guideline for GFOA, that say that at the minimum, that's what we should, you know, look at.
What's the average? You all
Okay.
work with many agencies, including some that I'm on the board with, and many communities in this area.
Mhm.
What is their average?
So, as of June 30th, 2018, because the economy was a little bit better than a few years ago, what I'm seeing is about probably 3 to 4 months for cities and towns, and about 6 months for fire districts. And they need 6 months, because fire district only gets most of their, you know, property tax.
You don't do minimal firefighters, do you?
No.
Oh, okay. They got like 6 years.
That would make your eyes open wide.
For 6 years, yeah. So, but it is, you know, a few years ago, you know, maybe 2009 or 2010, the entities were running on maybe a month or 2 months of, you know, reserve, so.
So, through the chair, as the town moves through its civic center project over the next 3 years, we'll be expending far more than $1 million a month on contract expenses. And the council has said that we're not gonna be touching our mandatory reserves, which is the $1.8 million. But the operations reserve, the other 2 point something,
2.4.
is accessible. But the $1.8 million
Mhm.
won't satisfy a 3-month reserve requirement, not requirement, but policy.
So, yes.
So just as a informational.
Mhm.
But maybe we should just consider the 6 month, looking at what our spend is in the 6 month. And if we have extra, we release that. I mean, we've talked about looking at and coming up with a balance, and I think perhaps with this information, we might wanna improve our projections, you know, and see where we should be.
Most of that 17.3 million, you take out the 1.8 and the 2.1, that's all gonna go to the Civic Center project.
Yeah.
Okay, yeah. And just something to keep in mind also, you know, you have to look at your revenue stream too. Your, it may not catch up with the COLA, so then you may want to have a little bit more research than some other cities that has the sales tax and, you know, other things.
But
So,
you're saying most are 3 or 6? Okay, great,
I'm
good
not-
information. That's what you're saying.
Right, that's what I'm
Average would be
seeing
others.
right
I'm
now,
not saying
yeah.
you're giving us advice,
Don't
okay?
try to,
I'm not saying you're giving us advice, okay? However,
Yeah.
I'm just trying to make sure that
Sure.
I understood what you have said, that the experience of other
Mhm.
communities similar are in between 3 and 6 months.
Right, and that's also the best practice of the GFOA,
Mhm.
is at least 3 months, 3 to 6.
All right, thank you.
Okay, welcome. So let's see what we have for next page. Okay, so do you have any questions on the financial statements before I go to the memorandum on internal control?
Yeah, I have a couple. On page 49 of the financial statements lists our total amount of money we have invested, $55 million.
Can I add that question too?
Now, our total government fund balance is a little over 40 million. I take it the rest of that is the OPEB trust balances and our, I would think it would be our prepaid balances and our pension, against our pension liabilities, but I think that number is gonna be too much, so I'm trying to figure out how you get to 55 million.
So on page 49, on that, of the 55 million, 6.2 million is the trust, that's in the
Right,
OPEB trust.
That's 6.259170.
Yes, sir.
And if
the-
I add that to the government fund balances, I'm still short by 9 million bucks.
Let's see.
Yeah, because if you go to the next page, also following on your comment, you know, it shows where all this money is stored in what type of funds, and we've got something like 55.095 million dollars.
Right.
So,
And so, I didn't know we had that. much
Well,
money.
you have to remember, a portion of that 48 million, we don't control, and that's the library component. That's the San Mateo County Library is part of that.
Well, yeah, but that's in the general fund balances, I think.
That's 8 million.
No,
Mm-mm.
that's in the library
No,
fund.
I understand where it is, but I've gotta go back to that page in the financials.
Is that what's called the San Mateo County Investment Pool?
Yes.
That's the library fund?
Mhm. On page 51, yes.
And is that,
So-
I know you've discussed the library thing before, but just so I can get my hands around it and make sure. So is that what causes the library fund that's restricted to the library to be so large? I mean, it's one of the larger things we have.
Mhm.
Okay.
Because
And
we
we can
can't
never
touch
move
that.
it to anything else, right?
Because of Prop 13.
Got it, okay.
okay, so.
Well, wait,
So-
isn't it true that that 8,045,000 that is identified as San Mateo County Investment Pool, that is the portion of the library fund
That we're over
managed
by us.
by us? No, managed by the
By the-
library.
So what we don't
Right.
The
have,
portion that's managed by us is about $4 million.
About 4 million, yeah.
And where's
And
that?
that's probably included in the California Local Agency Investment Fund.
Correct.
but that doesn't change my question. The library funds are included in total government funds on pages 22 and 23.
Mhm.
It shows library funds at $12,628,000.
Right.
So are we trying to build a relationship between the cash and investment and the fund balance? Is that our question?
That would be, yes.
Okay, so if you look at page 23, So
Which
you-
one?
23?
23,
That's okay, I'm on that.
okay. So total cash and investment for governmental funds, $45 million, right? So that makes up most of the assets. Then we have $5 million of liability that we need to take out in
Okay,
order to
yeah,
get
yeah.
to the 74,
Yep, I
right?
got that, but we'll still be short, but, okay.
So then you have another $3 million of cash and
It's
investment
internal
in the
service.
internal service fund, which is in page 34.
$45.
Okay, so the 45 million is on the.
That's the 3584 on page 34.
Total assets?
The 3191003.
Oh, just the cash and
Just the
investments,
cash,
current
just
the
assets,
cash.
okay.
Okay, so the 45 million in the governmental funds plus the
The
3 million
3.1.
is the 48 millions that you see on page 49, the first number on the top.
Okay,
Okay?
and then the trust, I got it.
Right.
Okay.
I'm happy.
If Bob's happy, I'm happy.
Well,
All these
Money on
pressure.
balances.
so now I spent an hour with Robert yesterday trying to resolve what I considered differences between the financial statements accounting of our pension contributions and his staff report. And clearly my IQ is not high enough to understand his explanation, because after an hour, I still don't quite get it. But it might be helpful if, the essence of some of it has to do with these deferred inflows and outflows.
Yeah, I'd love to understand that too.
Okay.
Now,
Yeah.
I think that
Page 62.
some of the money that we put in as a cash amount to pay for our unfunded liabilities on the pension side cannot be recognized instantaneously. They have to be, recognition is over a 5-year period.
The contribution will be recognized in the next year. The other changes will be spread out. So,
And,
So page,
Probably
page,
just
si-
confused
probably
me
page
more.
62, on note 7 on the top of the page. Yeah.
Yeah, okay. So the $1.9 million that was contributed into the pension trust by the town will be recognized in next year.
But it occurred,
Oh, no, that's not
This
the 1.9.
year.
I
Well-
don't think, no, actually it's the 1 point.
First of all,
It says, it refers to 1.937, right up in there for the year 2008, right, it's underneath section B.
No,
on
actually that
62.
is actually, that's a different number. It's,
Right.
pension expense is different than the contribution is on the next page. Page 63, the first number, the 1.28
right, is what we
million,
contributed.
yes.
So the 1.28 million includes our normal cost and our UAL payment. The normal cost of that 1.28 million that we paid through payroll was 630,000, 639.81. And the UAL payment that we made was 657,860. Those two numbers added together make up that 1.2 million as deferred outflows. That's what we contributed.
but that's cash that, we wrote checks for that amount in
We
that
paid it.
fiscal year.
Mhm.
So it's a deferred outflow only because you're not gonna post it, give us credit for it until next year's financial statements?
So on the fund level, you have reported it as an expenditure. On the entity-wide level, what happened is because the estimation of the liability is usually 1 year behind. So the number, what was the number? The pension liability number is as of June 30th, 2016. So Gatsby doesn't want you to recognize other expense after that number was estimated. That's why it got put into deferred outflow.
CalPERS is always 2 years behind us.
Yeah.
I know, I mean, I'm happy about it, but I know. But, I mean, the footnote's even more confusing because it says, as of June 30th, 2018, blah, blah, blah. Here's our, well, we got a liability of 16 million. Then you go down to the next paragraph.
Mhm.
It says it was actually measured on June 30th, 2017.
Mhm.
And it was measured on June 30th, 2017, based on numbers that were even a year before that.
Yes. So what happened
It's
is,
like a shell game.
yes, and then every single Gatsby, when they come out, they say it's supposed to help you to understand the financial statements better. So it's almost like a joke. So what happened is because these reports take so long the liability takes so long to do, if we had waited for the June 30th, 2018, we wouldn't be able to issue the financial statement until probably this June.
I understand.
And
Yeah.
Gatsby recognized that, so they say you can have up to 12 months for your measurement date. So the measurement date can go as far back as June 30th, 2017. But in order to compile those census data, what they're saying is that basically everybody who's worked here on June 30th, 2016 will be included in this estimation, this actuarial report. The staff that you hired after June 30th, 2016 is not even included in this estimate right now. So it takes them a long time to compile the obligation and then roll the number forward to June 30th, 2017. And then it takes them a few months to even give management the numbers. So in order for the financial statement to be issued closer to the year-end date, Gatsby allows for this difference. Now it's very common for when you are in like CalPERS. Sometimes when we see what we call a single employer trust, a lot of the water district has it, they manage, because it's just them, they manage to have the same year-end date as the pension trust. So they will have the same measurement date as the the entity's financial statement. If you have the same date, then there is no deferred outflow for that contribution that you make. So it's just easier if it is a single employer trust to be able to be more timely.
I can see that.
Yeah,
So the deferred inflows are monies that were put into the trust, or I mean, given to CalPERS after June 30th of 16 or 17?
17,
Okay,
okay,
so during fiscal year 18.
yes.
So the million, whatever it was.
2,280,000.
Yeah.
The 1.28.
And the deferred outflows are pension payments that were made during that time period?
So there is a lot more deferred outflow and inflow than just contribution. Some very smart, I mean, are we even allowed to say nerdier than us? Yeah, some people nerdier than us. One day woke up and go, hey, besides assets and liability, let's have all these other stuff. So they came up with 2 other categories called deferred inflow and outflow. Essentially, what it is kind of like a parking lot. These are the amounts that will be recognized in the income statement in future years, but they don't want it to recognize it in this year, so they park it all on the balance sheet. Items that will be recognized in the future years as an expense is called deferred outflow. But somehow it got parked right next to your assets, so it's very confusing. Okay, items that will be recognized as a revenue in future years is called deferred inflow. So it's a future debit balance and a future credit balance, if you can think about it that way.
But it's not as simple as contributions to pension
No.
plan and payments to pensioners.
Correct.
Right.
So
It's a
all-
bunch of other stuff.
Yes, so for example, when you see big fluctuations, a lot of times it has to do with the change in assumptions between last actuarial on this one, or the market fluctuations. So Gatsby feels like that, well, we don't want to recognize all these things in 1 year of income statements because otherwise it just go up and down. So they go, well, how about for this one, we'll stretch it for 5 years, and this one will stretch it for 3.8 years or something. So you will see these.
So who, I understand that. That part I kind of figured out.
Okay.
That's one of the few things I got out of yesterday's hour. So who figures all those numbers out? You don't do it.
No, the
We have
town.
actuarial.
And you don't do it.
No. We actuarial does that, and they get the information from CalPERS. They get the information from us, what we've contributed, and then they create this. It's like the OPEB actuarial, but they create this pension actuarial to satisfy this Gatsby
And did we
68.
just start that because of Gatsby, or have we always done it?
No, we had it. We started it in 15-16 fiscal year, because in that year was the year we had to implement our pension
So
fund.
this is the guy you said that would come and talk to us, who would be like having the OPEB actuarial guy come in and talk to us. We'll understand some of what he said. But
Well, CalPERS is different. So CalPERS gives them the information of what on the plan, and they take our information, and so they do it separate from CalPERS. They take both our information and come up with this actuarial. So they're separate from CalPERS. They're separate from us. And the name of the company that has done it for us for the last several years is GovInvest. They're the ones that do this net pension liability actuarial for us, because it's mandated. Once in 15-16 said we had to implement it. The first year, CalPERS did the reports for us because they needed a starting period. So CalPERS did the initial actuarial for us to have a starting point. After that, the following year, CalPERS says, we're not doing your Gatsby 68 valuations anymore. You have to go and get them done by an outside actuarial. So the implementation CalPERS did. After that, it's been an outside actuarial that does that for us.
Okay.
Bob, can I ask a question? So switching a little bit of gears to the OPEB, since we kind of already went through that. At one time, we had funded what we thought was our obligations for up to 90% of the people who had retired. And the rest was a pay-as-you-go.
Mm-hmm.
And since that time, we have more people continue to retire. You know, Sergeant Hall retired recently, and things like that. Are we planning on updating that so that we could decide whether or not we, if we can keep that 90% level? I would assume that we would have to pay more into it this year.
Well, now it depends, that OPEB plan is locked. We changed that 2 years ago. As far as any new members, the amount that they're getting as a
No, I
retiree.
understand that, but at that time, we funded to have N number of people,
Mhm.
all right? And we've added to the N, so N is now N+2,
Right.
unless we've had people die, I don't know if we have or not. But we've got now a guy who was on the regular payroll,
Right.
and he's now on the retirement, and he's got a family, by the way,
Mhm.
because we pay for the family as
Right.
well. And so the liability analysis should be higher, because he's now on the retired side as
Mhm.
opposed to the active side. And so that 90% level, to me, would need to raise. I realize it's current events, but there may have been others who,
Right.
I don't know what the situation was with Chief Flint, if we were covering him or not. It doesn't need to be discussed here,
Right.
but we should reevaluate
We do.
that and then make another payment into the restricted fund to keep us at that 90% level, which was a good area to be.
Correct, and because, and for the example, Sergeant Hall just retired, so in the valuation report that we have, he's not moved up into that retirement yet. When we do the next valuation, then we do a whole, what's the word, we do a census on the employee census, who's retired, who's under what plan, and we submit that to our valuation consultant, then they create the report again. So the reports have to be done every 2 years.
Okay,
To
so
capture that.
then you'll come back to the council and make a recommendation,
Right.
right?
Mhm.
Is the same thing done with regards to the pension? Because now we got Sergeant Hall retired, and he's now drawing down, and, there are other things where maybe a pensioner has passed away,
Mhm.
and do they do that evaluation for us as a?
Well, CalPERS does that, and that's where it's always built in, that's part of the assumption changes that happens from year to year.
Okay.
And that's where we get our valuation reports from CalPERS, that includes all of that. The amount of time people spent within an agency, they've probably spent time with different agencies, so that's figured into everybody's valuation reports. And so we'll pay into that, and that's where you have the UAL component, that comes into play now. And then we have our normal cost, so that gets updated, and again, they're behind 2 years, so, every other year it gets updated. And then the assumptions on the discount rate. If the discount rate was higher than expected in the current fiscal year, well, that year just finished, so the next valuation, what was made on the plan will be included into that valuation calculation.
There's no restatement.
Restatements?
Yeah.
No, it's just a
Goes
roll
forward.
forward. Mhm.
So on OPEB, we had this big hullabaloo when they changed the way they calculated our unfunded liability
Subsidy.
Okay.
with
Yeah. The implicit
explicit
subsidy.
and implicit.
Right.
I see no mention of that in this footnote, and I know for a fact we felt that it needed to be mentioned, because I presume that this liability of $12.5 million is both explicit and implicit.
Right, and it was in, we had it in last year's footnote disclosure about the
Yeah.
increase. And so that 12.5 million was the 12.5 million that was discussed in the 2017 financials. This now, because now it's implemented, it's in here, in the government-wide.
Yeah, but
It's
the
calculated.
language explains.
The language is in, but it was put in the 2017.
We can put a sentence in here,
Yeah,
I mean, since
we
we
can
have
add it.
that,
Yeah.
we have to,
Well,
yeah.
I mean, because we're never gonna pay this number. It's gonna be a much smaller number, and I think that, I mean, if we were talking $100,000, I wouldn't bring it up.
Okay.
But maybe you can put that in,
Right.
you did the sensitivity analysis later on
Mhm.
in here, where you did the different
Add
percentage
it in
rates.
there.
You might wanna put that in
Okay.
there and just, with a footnote. That might
We
be
can
the
do that.
appropriate place to do it.
We'll do that.
Well, it should, Should be,
Well, at
should
least
be in note eight.
Yeah, we'll put it in note 8, similar to last year, and then, and it'll be a discussion point in the management analysis under, the net pension, the OPEB liability component. We'll just put it in to see the note.
Okay. Good.
But on the OPEB, our liability right now is $4 million, and we have $6.2 million in the trust. And if you all remember, we've contributed up to the cap at that time was $5 million to the trust. So I think, in compared to other cities, we were proactive on that. Other cities aren't doing that. But so now they're showing a bigger liability because they haven't made contributions to their OPEBs or to a trust.
I'm looking at last year's, trying to find the note. I remember it was there.
I'll find it.
Yeah, I do it. It's a sentence.
Yeah, we updated it.
Here it is, to comply with newly revised actuarial standard of practice number 6. I remember that, ASOP 6,
Mhm.
our friend.
So we'll insert there that information into the note 8.
So last year, as a result of the required ASOP 6, the town's actuarial liability increased from 7.4 million to 12.5 million. That's what I'm saying, it's not chump change and we're never gonna pay it. So it really should be reflected, so that the almanac doesn't throw that $12 million number around like it's real.
Right, because it went from community rated plans to now the actual measurement of retirement plans.
Right. Okay, Catherine, go ahead.
Okay, so in conjunction with the financial statements, we issued a report. There are 2 reports in here. It's called Memorandum on Internal Control, which is the one that we note any control deficiencies, and there's the required communication. Because I think last year there was a question about why is there in one report. We just kind of bound them together, but actually there are 2 reports in here. So on the memorandum on internal control, we did not have any new items this year that we would like to bring to your attention. But we did follow up on last year's. Last year there was a comment on the information system review that the town has taken actions to implement our recommendations, and also the segregation of duty for journal entries. So last year our comment on journal entry was that the review of journal entry was not documented. So this year when we looked at it, it was documented. We still have that same concern about the system not limiting the same person to post it. But that's something that management cannot fix without a new system. So we did note here that we did see that the finance director is signing every single journal entry.
Right.
So that's in your 16-1-1?
Yes.
Yeah, so, you know, I read the whole thing. And the only thing is, in your next to last paragraph in the current status, the middle paragraph, I just have some concern with the last word in that paragraph. That it says that
There's a
okay,
risk.
it could
yeah.
lead to potential fraud. And I think, you know, personally, I wouldn't want to have in a report that says I have a system that could lead to potential fraud.
Yeah, we can reword that.
So I
Let's
think
see what
that
we
either that or I mean, you're satisfied that it would prevent fraud, or I think we as a town need to consider a way that we could eliminate where, to the point to where you would take that word out, because that word is a very harsh word that if I was just reading it, I'm a member of the public, I'd say, you guys need to really fix that, right?
So my understanding is there's a system limitation, so.
Right, and just to, like, all the journal entries are signed off on. It's just running a report in the system to match that all the journal entries that we have and we signed off on are the only journal entries. So it's just an additional layer, because we do have controls in place where only one person can enter a journal entry and one person can commit. But because of segregation of duties, one person does one job task that requires they can commit a journal entry, and the other person has a different job task that they can commit a journal entry as well. But it's not, it's because of the job duties that they're doing. It doesn't mean that if we take, I can commit journals, I can't enter journals. So if we take away that capability on both ends of the staff, then it would be hard to to have a task completed. So I sign on off all journals that get committed. I commit them, I sign off on them, I don't enter them, so there's the segregation of duty. The other layer that was mentioned was, okay, run a report of journal entries and just sign off that it's verified that what was signed off, these are what's been authorized. And that's the additional layer that we've implemented to combat that we can't completely segregate.
Well, then that
Some of
sounds
the
like,
duties.
you know, I realize we have a small staff and all that, but then it sounds like that fraud could not be,
Well, and that's just a layer to show that there's a control in there to eliminate the fraud. And that's just another layer that they're recommending. And because we can't segregate duties that way completely, we agree. We'll print a report, sign off on the report, and you can compare that the journals that were committed and signed off by the finance director are the actual journals that were authorized.
I hear what you're saying, Mayor.
Yeah.
We'll work together. and
yeah, I
figure out.
appreciate that. It's,
Okay.
it's, yeah. it's-
Okay,
Some people might read this report, other than us and the council, and the press might, and I think that's a good word to have in there. If we feel we've got it covered, and you feel we've got it covered, then that's a harsh word. And I would say, well, then we need to rewrite the processes or something like that to fix that.
okay,
You never wanna have a situation that could lead to fraud.
sure.
In the scenario that you're talking about here, during a review of the access log, it was noted both the AT and the junior accountant have the ability to prepare and commit. In order to commit fraud, there would need to be,
Two
use this word, collusion.
Right.
Yeah,
To do
and
that.
we did
Yeah.
And they
test
do
journal
testing.
entries
Okay.
too, so we did not see any exception, because we have brought to your attention, so this is more like a system,
Right.
a concern on the system. Okay.
Right.
So do you have any other questions I can answer?
I could probably ask questions about pensions for well into next week, but
But that's good, you're looking at the report, so it gives me comfort that you're looking at it.
well, what I was trying to do is put together a very concise document, showed how much money we put in the pension plan every year, and what the changes in the liabilities were, to show how fast we were losing ground. But I got numbers off of, in previous note 8s, you listed contributions made in years.
That was before the implementation.
Oh, yeah.
But once Gatsby
68.
68 kicked in,
Right.
now not only do you not list them, but they don't match up with the same fiscal
Oh, yeah,
year.
it's not even, because I'm looking at,
There's a way to do it. It's I'll do it before I leave this committee if it kills me.
It's part of the problem that we pay them at the end of the year, so we wait till the last minute or as long as we can, then we write them a check.
We actually pay them at the very
We pay
beginning.
them at the beginning of the
And
year.
then they take forever to allocate it to the funds and
Yeah.
process it and things like that before they say, okay, here you are. Right. You know, I can see that there's delay, especially at their end.
Mhm.
Then on top of all that stuff, they keep changing the discount rate, Okay, so every time we pay down the thing, our liabilities with them are as high as they were when we thought we had a fiscal emergency back in 2009. Honestly, I was just talking to Georgia about that. We're right back where we were. And, it's like going in a boat, right?
It's like Alice in Wonderland. You
Preaching
have
to
to
the
run,
choir.
you have to run just as fast as you can to stop from going
I
backwards.
did.
Get anywhere, run twice as fast.
Any other questions for Catherine?
No, I was just gonna point out that, the historical data for the contribution to the pensions on page 77 in case you, hopefully that will help not kill you by compiling this data. And page 76, I know it's a one fiscal year off, so it's very strange, but page 76 lists out the historical data for the pension liability. So if you,
Actually, I didn't see this page. Somehow I didn't get this far.
So if you
I
have
kind of
trouble
quit after
sleeping-
note 8.
Read this
so
page.
just keep in mind, page 76 is as of measurement days, and page 77 is the year-end date, so there is a difference in one fiscal year. Okay?
Yes, thank
Okay,
you.
so you're welcome, so that may give you some information.
If you think of anything else that's going to lengthen my life, call me.
We will.
No more questions for Catherine? Okay, thank you very much.
Thank you
Thank
so
you.
much, thanks for having me. Now that we're off this weekend.
Thank you
you.
so much,
You're
Catherine.
welcome.
Appreciate it.
So we don't have anything else on the agenda except confirming what our next meeting date is.
But the only thing real quick is just a recommendation. We'll make the changes first. Just a recommendation for that the council accept these financial reports.
Are you going to include this presentation?
With the council packet? Yes.
Yeah, because I thought this was a presentation.
Yes.
Yes, I would move that we make that recommendation to the council. If I can get a second. Okay, all in favor?
Aye.
All right.
I'm not voting.
Good now, Robert?
Thank you.
Next
Thank you,
meeting date?
Catherine. Appreciate it.
Thanks very much.
Yes, sir. The next meeting is March. I have it. Sorry. March 12th. Tuesday, March 12th.
All right, if nobody has anything else, we can adjourn the meeting.
Need a motion?
So moved.
I'll second it myself. All in favor?
Aye.
Thanks, everybody.
Thank you all.
Why would you be so quick to second it?
I can move things along faster, but